It's a very difficult year for landing on an appropriate allocation for risk assets because we see incredibly wide dispersion in their potential performance. If central banks are going to be highly accommodative as they've suggested, we can have an environment where the incoming data is very, very weak, which would ordinarily not be friendly to risk assets, but the markets focus on that extra policy accommodation and risk assets do really well. And that's broadly what we've seen over the course of this early part of 2019, where the incoming macro data has been as weak as we've seen in a number of years, and yet risk assets have done nothing but rally. Conversely, in the fixed income markets, we know that the Federal Reserve are no longer going to be hiking interest rates materially. We know what the supply outlook looks like in terms of future borrowing requirements. Both of those things were scaring markets last year and generating yields to rise a bit. Obviously a very powerful performance at the back end of last year, but going forward this year we believe that the performance is very predictable in terms of what we'd expect the markets to do, with two fairly clear avenues to material performance. One being a material credit event, in which case particularly government bonds would do incredibly well as under a flight to quality type movement in markets, when people become much more worried about the return of their capital than return on their capital. Or conversely under that very heavily accommodative period where all assets would do quite well and government bonds would be again swept up inside of that. So I think in terms of, if you're sitting on an investment committee and having to make these decisions, I sympathise that the equity part of that decision is quite complex this year because clearly if there isn't that support from central banks and that essentially central bank put mechanism, well, given the data that's incoming, we'd be in a very different phase from where we are now, but the bond allocation looks pretty clean. So actively managed government bonds obviously provide portfolios with ballast. It's a defend and protect asset, wonderfully liquid, AAA rated, and it allows for some reduction in portfolio volatility and very strong performance, and government bonds being the best performing asset class in Australian portfolios in 2018. They're already doing very well again in 2019, and RBA rate cuts will only further support that looking forward. So if you are worried about the outlook for risk markets and you want to get to high ground, move to something that's very conservative where the capital and principal is guaranteed by the government, not a corporation or an equity-like allocation, clearly subject to much more volatility, then government bonds is a sensible place to reside, and we believe an evergreen allocation in terms of building a well-diversified portfolio.